and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are mixing journey towards financial freedom, financial product, financial well-being, so you, like me, can reach your goals sometime in the future. Now let's get into this latest video. Now this video is about my self-invested personal pension plan. Now I do have a plan with my employer through auto-enrollment, but it's a simple scheme. I pay in 8% between me and my employer, but I'm limited on the funds I can pick, so I have my own funds, or my own product, from my own platform provider, so I can control my investments and the level of contributions I make and pick my own funds. Now it's not to boast or brag, it's to say to people, if I can build a portfolio of 6 figures, so can you, all within a tax-free wrapper if you take some kind of plans, some kind of actions and implement some kind of plan. So let's dive into the video. So what are the aims of the portfolio? Well, the aim is annual growth of 10%. We're looking for dividends of 2024 of £5,500, and we're looking for a year-end valuation of £117,000. So how have we done in the month? Well, we start in the month at £100,467. We ended the month at £112,842. So an increase in the month of £2,375. So a very good start compared to January. And year to date, our fund is up 0.51%, so better than the index. We made monthly contributions, £250 first of each month, and the government will give us tax relief as a basic rate taxpayer of £62.50. Our platform provider fees were £15.66, which is about the same on average, because it's based upon a percentage of our portfolio valuation. So where exactly is the funds held? Well, we were UK solely based, we're reducing that slightly at the moment. 80% in UK and Europe, 17.7% in USA and Americas, and 2.3% in Asia and emerging markets. Now, not the greatest amount for dividends, just one dividend as the following chart. AJ Bell, the platform provider, gave us £18.92. We didn't reinvest because of the size dividends. So year to date, £56.02, but some great results in the month. Dividends will increase, shall we say, April, May. We were expecting £917, so we're well below the threshold. But our shareholdings, we've got an average yield of 4.44%. We'll have good months with bad months, but just go to show our portfolio starts off on a slow basis, but the results have been enjoyed this month of March, and dividends will be increased dramatically over the coming months. Let's dive into our portfolio and see what sort of shares or funds we hold first. So, our shares. At the moment, we own 15 shares, 10 in profit, 5 in loss. Makes up 75% of our portfolio. Total holdings of £84,125, of which 66% is in the FTSE 100 and 9% is in the FTSE 250. Look at the following graphic. What sort of holdings do we hold? Well, our largest holding is Aviva, 4,655 shares, nearly 21,000, 18% of our portfolio. Very nice yield, around about 7-8%. Results will be due out at the start of March, so hopefully dividends increase, but we can just switch off. It does what it says on the tin. Everyone needs insurance, very cash rich, and the dividends have been increased over the past few years. So hopefully that will be carried on moving forward when results are out. We own Lloyds, the banking group, 36,162 shares, £16,000. Hasn't a good run lately, 14% of our portfolio, because the results were out in February. It's given a yield of 6.8%. Last year's annual final dividend 1.6p. This year is 1.84, so a very nice dividend will be paid in May. We own Greggs the Bakers, 283 shares, £7,600, nearly 7% of our portfolio. Very cash rich. Is on the growth spree, friendly few shops, forecourt, shall we say, away from the high street, but it is a very profitable company, and it's all 100% since we bought that share. Back on the banking sector, we own HSBC, 1,149 shares, £7,000, 6% of our portfolio. Again, results were out, not the greatest because what's happened in China, but it is paying a quarterly dividend, 8.5% yield, and it is paying a special dividend because it sold some operation in Canada, and it will pay, shall we say, a very nice dividend and a special dividend moving forward, which will be invested, but quarterly dividends away from the UK banking sector. We own Drax, the biomass oil pellet maker. 1,254 shares, £5,900, 5% of our portfolio. Has struggled recently, but results are out at the start of March. Hopefully dividends will be increased. But again, it's very cash rich and it wasn't a buying spree over the past 2-3 years, but it's been affected by short-term market sentiments. Again, it was up over 100% since we bought that share, but it has fallen in the past few months. But it's a long-term buyer, shall we say. Back onto the insurance companies, we own Legal & General. 2,098 shares, £5,000, 4.5%, just like Aviva, we switch off, does what it says in the tin, but it is a big play over in the pension investment market. A very nice yield, around about 8%, and hopefully like Aviva, results will be out start of March, and the dividends will be increased. We own Barclays, 3,088 shares, £5,100, 4.5% of our portfolio. Again, results were out in February, very good results, a yield of 5.5%. Last year's final dividend was 4.5p, this year is 5.3p, so it will pay a nice dividend in April. We own Sainsbury's, 1,248 shares, £3,000, 2.8%. Did have very good results in December, dividend increase, but it has struggled recently, come off its highs, but it has been gaining market share against a recent quarterly survey. We own Shell, £3,700. We own BP, £2,500, and they will pay very nice quarterly dividends during the month of March. And then we own JD Sports, £2,500, £3,000 of a portfolio, 2.6%. It's very cash rich, has £1 billion in cash, has been on a buying spree in America, but it has been affected by a poor trading statement in the USA. But again, it was 100% since we bought it. It is very cash rich, it is a growth spree, and it has been, shall we say, on a buying spree, mainly in the US, but also in Europe and Asia. Other companies we own is Pennon, the water company. We own AJ Bar, the drink provider. We own AJ Bell, the platform provider, and we own Card Factory. But we see no reason why we're going to sell any of them 15 shares within the short term. They're all long-term holds. And as we said, some very nice dividends due during the month, which we paid in April, May, and hopefully some very nice dividends to be announced in March based upon the insurance companies. Remember, they're my own personal opinions. They were done for a reason. Okay, predominantly based in financial services, what we know about, but we can just switch off. Everybody needs them products. Remember, if you like the videos, smash the like button, subscribe to the channel. Now let's look at the funds held within the portfolio. In the portfolio, quite selective, we own 4 funds. 3 in profit, 1 in loss. Makes up 25% of our portfolio. Total fund values of £28,000. Our funds, as per the chart, is a Legal & General Technology Fund. £11,600, 10% of our portfolio, we can just switch off. Had a great results, shall we say, in 2023. The fund was up 53% after the poor 2022. But let's just say predominantly based because of the so-called Magnificent Seven on some kind of bull run. But it owns, shall we say, around about 150 tech stocks. And very low fees, and it does pay a dividend. We own a Fidelity World Index Fund, £11,479, 10% of our portfolio. And we do top that fund up on a monthly basis. We put in £300, our contribution on a tax relief. We can just switch off. Owns around about 3,500 funds, or shares, shall we say, and a very low fee of 0.12%. Now we own a Global Growth Fund, £2,800, 2.4% of our portfolio, are 1 fund in loss. It's down about 7% since we bought it. It may well be when that fund recovers, we're going to put that into our index fund just to simplify it because reduce fees, so we say, and manage the account. But hopefully it'll be back in profit in the coming weeks and months. And then finally, a Lindsell Train UK Equity Fund, £2,750, 2.4% of our portfolio. Quite selective, owns about 30 stocks or funds, so we say, but all quality names. We can just switch off. But it's bought because of an excellent track record over the last 10 to 15 years. obviously based upon UK funds, but it's done for a reason. We can just switch off and ignore market noise. It was done for a reason. So as I've said, 4 funds, again, like our shares, all long-term holds. Apart from profit, we're going to put that fund in our Federal World Index, 1, for reduced costs, and 2, for greater exposure, shall we say, away from the UK stocks. But we've done it for a reason, to simplify our account, because we're going to be paying less fees and simplify our portfolio. Remember, my own personal opinions, they were done for a reason. So we've had a good, shall we say, February. Hopefully that continue moving forwards. It's not a get-rich-quick scheme, but it just goes to show, if I can build a portfolio of 6 figures, you can too. It may take you, let's just say, 5 to 10 years, like myself, but you can get there if you case on a plan and you put the wheels in motion. And remember to invest within a tax-free pension wrapper.